Welcome to online lectures by CA Studies. For more lectures online, please do visit castudies.lk.
Now come to the question that is in page number 15, right? That is a lorry bought for a business cost rupees 17 million. It's expected to last for 5 years and then be sold for scrap for rupees 2 million. Required: work out the depreciation to be charged each year under straight line method or reducing balance method. Straight line method or reducing balance method. In reducing balance method, depreciation rate is 35%, right? So standard allows to use the two methods of depreciation. First one is depreciation reducing method, second one is straight line method. Both are acceptable, right? There is no standard recommendation for one method. Both method can be allowed, right? Now once you read this type of question, summarize that, right? When reading the question, in question itself summarize. Cost of the building is 17 million. Scrap value means sale value. Sale value means after lifetime of the building, what is the balance amount can be flowed to the entity. That is called future economic benefit. Residual value of building is 2 million. Right. Residual value of the building is 2 million. Therefore, depreciable amount is 15 million. There is nothing to buy at. Definition of the depreciation is we can produce from year. Understand is enough, right? Definition by heart is no need, my dear friends, right? Definition of the depreciation is recovering the cost of the non-current asset, right, from the profit earned by the company year by year. So depreciation means recovering the cost of. Business means all the business to recover the cost. So if 10 million spent, 10 million should be recovered, and extra money also should be recovered. That is called profit. Say profit is 1 million. So profit 1 million, cost 10 million, sale should be 11 million. This is profit, my dear friends. All the cost spent for business should be recovered. So depreciation is one of the method of recovering the cost of the non-current asset. So non-current asset we cannot charge, non-current asset expense we cannot charge in one. We charging over the lifetime of the year. That is called matching concept, right? If the expense is charged, right? If expense happen, that expense future economic benefit flow to the entity. That's why cost of goods sold calculated is opening balance, opening stock plus purchase minus closing stock. Matching concept say the expense should be charged to the P&L that is related to income. If income is 100 million, right, that 100 million, to earn this 100 million income, how much we spend, that is only charge. So 10 years building can be used means 1 year we use this building and earn the 100 million. So one year we used, so 1 year building cost should be charged under this. That is called matching concept. Due to the matching concept, only depreciation should be charged over the lifetime of the year, right? Now 2 million. So balance depreciable amount is 15 million. Lifetime of the building is 5 years. Lifetime of the building is 5 years, right? Reducing balance method, percentage is 35%. So according to standard straight line method depreciation, answer is 17 million minus 2 million, so 5 years lifetime. So per year lifetime, per year depreciation is 3 million for this, right? 3 million is depreciation. It's very easy. So our double entry is debit depreciation of lorry 3 million, credit accumulated depreciation of lorry 3 million, right? Now reducing balance method. So over the 5 years, first year depreciation is this, second year depreciation is also same, right? Same calculation, right? Now come to the reducing method, reducing balance method depreciation. First year depreciation is 17 million, 35%. Depreciation should be 5,950,000, right? So second year depreciation should be 17 million minus accumulated depreciation, reducing method, right? Accumulated depreciation into 35%, reducing balance method. So to first year, right, this is a first year depreciation is this much. First year accumulated depreciation is 5,950,000. So carrying value is 17 million minus 5,950,000 is 17 million minus 5,950,000 is 11,050,000. So for the 11,050,000 we calculate the 30% again. So this should be 11,050,000, right? 11,050,000. So straight line method is over the lifetime we depreciate. Here on the carrying value take the depreciation rate. The depreciation rate is decided by the company. Here a question given, so it's very easy. So 35% is how much? 3,867,500. So accumulated depreciation is 5,950 plus 5,950, 9,817,500. Now accumulated depreciation is 9,817,500. Now deduct the accumulated depreciation from the 17 million. 7,182,500. Now third year depreciation. This is first year, this is second year, this is third year. Third year depreciation 7,182,500 into 35%. How much? $2,513,875. Now accumulated depreciation is this plus this. Don't be lazy, please work out. Carrying value is 17 million minus accumulated depreciation is 12,331,375. 4,668,625. Now fourth year depreciation. Fourth year depreciation is 4,668,625 into 35%. 1,634,000 9 plus 13,965,394. Carrying value is 3,34,606. Final year depreciation is 3,34,606 into 35 percentage, 1,62,130. Now it's 15,27,506. Carrying value is now is the complex part. Carrying value is 17 million. Now carrying value coming 1972493. Actually this carrying value should be 2 million, right? 2 million is the scrap value, right? 2 million is the scrap value. So here straight line method also same thing. Each and every year charging the 3 million. So 5 years we charging the 3 million. It's equal to 15 million, right? Cost 15 million. 15 million will be the accumulated depreciation. Cost of the building is 17 million. Cost of the lorry is 17 million. So 2 million is scrap value. This should be the scrap value in any method. Straight line method to reducing method. Now reducing method 1.9 million balance. So this calculation is wrong. Final calculation is wrong. Therefore this depreciation should be the difference amount, right? Say this is I am going to change to 2 million. After 5 years this balance should be 2 million. Now if this is a 2 million, what will be the depreciation value? This balance is 2 million. What will be the accumulated depreciation? 15 million, right? 17 million minus 15 million, 2 million. So what should be the depreciation amount? From 15 million minus the previous year accumulated depreciation. 15 million minus 13965,394. 1 million This should be the correct depreciation value. Always keep your mind, reducing balance method, last year only this complex part will come. Please keep your mind, even though reducing balance method or straight line method, scrap value will not be changed. Scrap value means after the lifetime of the lorry, recovered amount. So it is a future economic benefit of the business, future economic benefit of the lorry. So it cannot be changed. Okay, now let's look at come to the next topic, that is change in method of depreciation. So from the straight line method we can change to the reducing balance method, or reducing balance method we can change the straight line method. Next question is here. Take to the page number 16. Next question is Jait company purchased an asset for 10 million. Right? I'll take this side. I don't want to delete this. Purchase the asset for 10 million. Better read the question first time. Second time reading, take a note. Right? Normally in the chartered we have to practice, at least we have to read the question 3 times. Please please read the question 3 times. You will definitely will not understand in first time. First problem is English. All of you, your mother tongue is Tamil or Sinhala. So English problem. Second one is exam pressure. In the exam pressure, information may not be read properly. Second one. Third one is your concentration. In the exam hall, you will be hearing different sounds. So first time reading, supervisor katha karana. Are the එළිය මොනාර සද්ද එනවා. ඒ problems තියෙනවා. That's why first time reading just read like a story. Second time reading read slowly and take notes. Third time reading, try to build the answer in your mind. Right? Then start to write the answer. First time I am reading. Jait company purchased an asset for 10 million on 1st January 2021. It had an estimated useful life is 5 years. Right? And it was depreciated using the reducing balance method at a rate of 40%. On 1st Jan 2023, it was decided to change the method of straight line. So the depreciation charge for each year from 31st December of the asset's life. Okay, so here let's take a note. First we purchased the Jait company purchased an asset for 10 million. Cost of the asset is 10 million. Take a note of this. 10 million. Lifetime of the building was 5 years. Is there so scrap value of the building is 0. Take a note of this. Right? Now purchase day was 1st January 2021. Right? So 1st January 2021 to 31st December 2021. So 1 year. Second year is 31st December 2022. Third year 31st December 2023. Fourth year 31st December 2024. Fifth year 31 December 2025. Right? Now using the reducing balance method. So reducing balance method is the method. Depreciation charge is 40%. Now it says on 1st Jan 2023. On 1st Jan. So here from 1st Jan 2022 to 2 here. So on 1st Jan 2023. So from this day onwards. So third year, fourth year, fifth year depreciation policy changed. First and second year reducing balance method. Straight line method. Third one. Fourth also straight line method. Fifth one also straight line method. Now we took a note. This is the question note. Now show the depreciation charge for each year. Okay. First year depreciation is how much? Reducing balance method. 10 million into 40%. 10 million, right? I am taking as a 10 million into 40%. It's 4 million, right? Second one, reducing balance method, right? So carrying value of the building now is, so depreciation is 4 million, right? Carrying value of the building is now 10 million minus 4 million, 6 million. Now for 6 million, 40%, second year. That is how much? That is 2.4 million. Now total depreciation is 6.4 million, right? Now 6 million minus 2.4 million, 4.6 million is carrying value. From third year onwards, straight line basis. 2 years finished, right? Third year is 4.6 million is carrying value. Now from third year onwards, straight line method. Straight line method How much we have to take straight line method depreciation? How we have to calculate cost taking realizable value? නැත්නම් scrap value එක අඩු කරනවා depreciable amount එක යනවා. හරිද? මේ depreciable amount එක lifetime එකෙන් divide කරනවා. හරිද? මේ depreciable amount එක x නම් ඒක lifetime එකෙන් බෙදනවා. එතකොට depreciation payment එනවා. Then lifetime is how much? Now cost is how much? Balance value is 4.6 million. So 4.6 million we have to reduce for next 3 years. Scrap value is 0, depreciable amount is 4.6 million. So 2 years we have completed, balance 3 years we have to charge. Now 4.6 million divided by 3. How much is that? That is 1,533,000. 1,533,333. Right? This will be the depreciation for each year. Right. First year depreciation is 1.5. I'll take 1.53. Second year also 1.53. Third year also 1.53. 4.6 1.53. 3.1. Right? 3.1 1.53. Balance 1.53. 7. I'll take as a 6. It will be finished quickly. 1.53 minus 1.53 0 million. Now after a year there is no value for this asset. This is how it's changed upon, right? Now let's look at the next question. Now we found we practiced the question for changes in the depreciation method. Next one is changes in change in expected useful lifetime. Right? Read the next para, same page. Depreciation charge on non-current asset depends not only the cost or value of the asset and its estimated residual value, but also its estimated useful life. A business purchases a non-current asset costing 12 million with an estimated life of 4 years. Right. Now different question. Question is 12 million. 12 million is purchase cost. Estimated lifetime is 4 years. No residual value. Residual value is 0. So depreciable amount over the period is 4 years. 12 million. Over the 4 years is 12 million. It would be an annual allowance 25% of 4 years mean 25, right? If 100% is full, 4 years mean 25% per year. So reducing balance method, not a reducing balance method, straight line balance depreciation is 25%. Now what would happen if the business decided after 2 years that useful life of the asset has been underestimated, then still add 5 more years in use to come, making its total life 7 years. This is very critical point. If you do not know the meaning of read from here, and it still at 5 more years in use. After 2 years another 5 years there, so total 4 years, right? After 2 years means balance 2 years there. After 2 years balance 2 years there. From that another 5 years. So altogether 7 years extra there. Already 2 years gone and 2 years again there. From there 5 years again there, right? Now altogether 7 years balance there, right? So total asset useful time now is 9 years. 2 years finished, 2 years there, 5 years added. So 4 plus 5, 9. 9 should be the total, but balance 7 years there. So balance carrying value should be depreciated over next 7 years, right? Reading should be understood, right? Now sometime question will be saying after 2 years companies come to know total life of this building was 10 years. Now total life from the beginning onwards 10 years. Now already 2 gone, so balance 8 there. That is the understanding, right? That's why understanding the English also very important here. Now it's asking now that what happened, decided after 2 years used to come, making total 7 years. Still it's asking a question. Now what would happen if the business decided after 2 years the useful life of the asset has been underestimated and still had 5 more years in used to make come, making its total life 7 years. Now let's look at how it's changed. So 2 years depreciation is 1 year first year 1 depreciation. Year 1 depreciation is 12 million divided by 4, 3 million, right? 3 million. So accumulated depreciation also 3 million. So cost is 12 million, right? 12 million. Carrying value is 12 million minus 3 million, 9 million. Second year depreciation is again 3 million, no change. So accumulated depreciation is now 6 million. Cost of the building not change, no renovation, no revaluation, not change. So again 12 million. This is a table we are using normally, right? 12 million minus 6 million, carrying value is 6 million. Now carrying value is 6 million, right? Now depreciation rate, depreciation extra 5 years added, right? Now year 3 onwards, this 6 million balance carrying value should be depreciated next 7 years. So 6 divided by 7 from year. 60 divided by 7, how much? 7 into 8, 56, 5.6, 47, 35, in 57 is 7, so 5, 7, 0.857, is it correct? 0.875 million. I'll just check. 6 divided by 7, yeah, 857, it's correct. So next year, for third year depreciation is after 2 years that the useful life of the asset has been underestimated and still at 5 more years in use to coming. Still at 5 more years. From this onward 5 more. I'm sorry, so I am wrong. After use 2 years, balance 5 years. So balance 3 years added. So it should be depreciated over 5 years. Balance 5 years, huh? So 6 million into 5, 1.2 million. So accumulated depreciation is 7.2 million. Second year. Cost is not changed. 12 million. 12 million minus 7.2, 4.8 million is balance. So if each year depreciation is 1.8 million, from year onwards, 5 years, year 3, year 4, year 3, year 4, year 5, year 6, year 7. Until year 7, 1.2 million is depreciation per year. After that, carrying value will be 0. Right. Now, depreciation is not a cash expense. Yeah, depreciation is not a cash expense. Now come to the page number 17. It says question, come to the question, that is, what are the purposes of making allowance for depreciation? Second one is, in what circumstances is the reducing balance method or more appropriate than the straight line method? Giving a reason for your answer. First question, what are the purpose of making an allowance for depreciation, is the account of the business try to recognize that the cost of the non-current asset gradually consumed as the asset wears out. This is done by gradually writing off the assets cost in the statement of profit or loss. What I said is explained here. Now this is done by gradually writing the asset cost in profit or loss over several accounting periods. This process is known as the depreciation. Is an example of accrual assumption. LK 16, property, plant and equipment requires that depreciation should be allocated on a systematic basis to each accounting period during the useful life of the asset. With regard to the accrual principle, it is fair that the profit should be reduced by the depreciation charge. This is not an arbitrary exercise. Depreciation is not as is sometimes opposed. An attempt to set aside funds to purchase new non-current assets when required. Depreciation is not generally allowed on freehold land because it does not wear out unless it is held for mining, etc. The reducing balance method depreciation used instead of straight line method when it is considered fair to allocate a greater proportion of the total depreciation amount to the earliest year and a lower proportion to the later years, on the assumption that the benefit obtained by the business from using the asset decline over time. In favor of this method, it may be argued that it links the depreciation charge to the cost of maintaining and running the asset. In the early years, these costs are low and depreciation charge is high, while in later year. In the reducing balance method, if you using the reducing balance method, right, 35%. Here depreciation charge is 5.9 million. Here depreciation charge is 3 million. So in first year we can recover 5.9 million from our asset. Over the year, recovering from the asset will be reduced. Depreciation expense will be reduced because over the year we also assume that over the year assets performance will be reduced. If we buy the new laptops works faster today. After 2 years, definitely it will be slow. Phone also same thing. Year by year, right? Month by month, day by day, assets performance will be definitely low. See, one vehicle bought in the 1980s. If you run that vehicle today, definitely that performance is lower than the today's vehicle. Over the year, gradually that performance of the asset will be definitely reduced. That's why charging the higher depreciation when assets performing well is better than charging the equal depreciation for each year, even not considering the performance well or not, is not better. That's why reducing balance method justification. It's a justification of using the reducing balance method. Is better, right? Now let's come to the question that is in that is in page number 23, revaluation. So depreciation explanation is enough, right? When we doing the financial statements, let's look at deep explanation. Let's talk these each financial statement item with the preparation of the financial statement. We have already prepared the profit or loss and balance sheet. I think there are 3 questions we have done, right? I will do further question. Now let's look at a question for revaluation. Here, when Frank Amarasinghe commenced trading as a car hire dealer on Jan 1st 2021, he purchased business premises at cost of 50 million. Business premises cost is 50 million. Business premises means building. Cost is 50 million. For the purpose of accounting for depreciation, he decided the following. Land part of the business premises was worth 20 million. Right. This would not be depreciated. Land part will not be depreciated. Question itself given a information. B. The building part of the business premises was worth the remaining rupees 30 million. This would be depreciated by straight line method to a nil residual value over 30 years. Now let's take a note. Premises cost is 50 million. So land is 20 million. Building is 30 million. So building lifetime is 30 years. So building residual value is 0. After 5 years of trading on 1st January 2026, Frank decides that his business premises are now worth 150 million divided into land 75 million, building 75 million, 150 million. After 5 years, right? Now he estimate the building still as a further 25 years. After 5 years, he thinks further 25 years. So altogether 30 years. So original years and after evaluation also lifetime of the building and land are same. Calculate the annual charge for depreciation in each of 30 years of its life and the statement of financial position value of the land and building as at the end of the each year. So 30 years financial statements we have to prepare. Then 30 years depreciation, accumulated depreciation we have to found. Now let's calculate and do the calculate and see how these financial statements figures are changed. After 5 years. So after 5 years land value is 75 million. Building value is 75 million. So premises value is 150 million. Right? Let's see how much is the revaluation cost. So each after 5 years he estimates lifetime of the building is 25 years. Right? Residual value is information not given, therefore we assume 0. Right? Let's see the calculation now. Right. So this is happening on 2021 January 1st. So after 5 years mean 2026 January 1st. Now let's calculate the depreciation. So building depreciation. 2021 right, 2021 year, depreciation is, building is 30 million, no scrap value is 0, so first year depreciation is 1 million, so 1 million is depreciation, right. Second year also 30 million, so accumulated depreciation is 1 million, so balance useful lifetime is 29 years. This is a one method, or we can say this also, this is a balance year depreciation, so this is also 1 million. So third year depreciation 23 30 million, cost will not be changed, normal correct practice is this. Now accumulated depreciation is 2 million, now divided by 28 years, value is again 1 million. 2024 also same thing, my dear friends, I think I don't need to calculate, right. 2021 also, if you can put the formulas here and find out and WhatsApp me, I will say it's correct or not, right. 1 million. Now after 5 years accumulated depreciation is 5 million. So I will prepare the 2025 balance sheet only. Balance sheet as at 31st December 2025. Cost, accumulated depreciation, carrying value. It's a land. Land is how much? 20 million. Land carrying value is 20 million. Building cost is 30 million. Building accumulated depreciation is 5 million. Building carrying value is 25 million. So non-current asset balance on 31st December 2025 is 45 million. So here, so this is double entry for, this is debit depreciation of building, right, 1 million. Credit accumulated depreciation 1 million. So each double entry will be same, this double entry 1 year 1 2 3 4 5 double entry will be same. So accumulated depreciation, each and every year depreciation amount will be transferred to P&L like this. Depreciation, say 2021 depreciation we charge 1 million, right. So this 1 million will be transferred to P&L transfer करना, but it's accumulated depreciation 2021 here 1 million there. This is brought forward until this building disposed, until this land and building sold, we have to keep the related expenditure, accumulated expenditure and accumulated income with the company until disposed, until this is actually realized. Now 1 million. So first year balance carry forward is 1 million. So each year will go like this, and after 5 years 5 million is the balance carry forward for accumulated depreciation. Now balance is 25 million. Now after 5 years, right, after preparing this balance sheet, revalue the land and building 1 million, 150 million, 150 million. Now let's work out the revaluation. Now revaluation. Land revaluation is how much? 150 million. Land carrying value is how much? Always revaluation minus carrying value. Carrying value is how much? 20 million. Sorry, 75 million is the revaluation. 20 million. So land revaluation is 55 million. So each transactions in the business should have the double entry. If double entries are not there, we cannot record. Each and every transaction, please, in your mind automatically the double entry should cycle. Right? You have to find out the double entry for each transaction. So here double entry will be 55 million extra. So debit land account 55 million. Credit revaluation surplus account. Right, now this is done, right? This is no problem. Now I will prepare the balance sheet of 2026 and profit or loss in 2026. Then you will understand. Sorry. Revaluation will be take place on 1st January 2026. Okay, so 1st January 2026 is revaluation take place, not a 31st December 2025. If revaluation take place on 31st December 2025, it should be reflected in the 2025 financial year. Because one day late, it should be reflected in the next year financial statement. Keep your mind. First day revaluing, right? Only one day late. So first day revaluing. In the land account will be like this. Land account. 1st January 2026. Balance brought forward of land is 20 million, right? 20 million. So revaluation take place here. So we have to pass the double entry. So revaluation surplus. Revaluation surplus of the building 55 million. Right? Now revaluation account we have to open. Revaluation account. $55 million land. 1st January 2026 land account. How much? 55 million. Now passed. This is happened on 1st Jan 2026. Dates are very important. Now building also revalued. Now building. Let's take a building. Building is now carrying value is how much? Revaluation how much? Carrying value is how much? Revaluation is 75 million. Carrying value is 25 million. So 50 million revaluation surplus. Now pass the double entry. Each and every entry pass the double entry. Don't be lazy. Even though final level I am used to practice the double entry system, right? Consolidation also in corporate level, I am definitely using the double entry system. Double entry system is the best method. Column methods, then T accounts method, then all the methods forget about. Use the double entry method, plus and minus put into straight to the financial statement. Consolidation of the financial statements will be easier for you. Double entry system follow. Lucas Beggioli saying all the transactions should have the double entry. So all the accounting students should follow the double entry system. So if double entry system followed, definitely your exam will be easier, right? Your transaction will be easier. Find out. Double entry cannot be found out. Please contact me. I will help you. Right now, 50 million double entry. What is the double entry? Debit building. Debit building 50 million. Credit. Yeah, I am putting 50 million, right? Instead of taking the 6 zeros. Building credit revaluation surplus, right? Surplus 50 million. Now open a building account also now. Open a building account. Now opening a building account. Building account already at the brought forward cost. Brought forward cost is how much? Brought forward cost is 30 million. Now revaluation surplus is 50 million. Revaluation 50 million, right? Don't close the accounts until finished. It's opened on 1st Jan 2026. Account will be closed on 31st December 2026 after 12 months. Now it says again a 25 years balance depreciation there. Now we'll calculate the 2026 depreciation, right? I'll take this side. 2026 depreciation. From first day onwards, the revaluation surplus will be charged, right? So 80 million is the cost of the building now. Cost of the building 85 million, right? So how we have to calculate the depreciation? How we have to calculate the depreciation, right? First we have to 80 say cost is 85 million, right? What is the accumulated depreciation for building up to now? Up to now accumulated depreciation is 5 million. So carrying value of the building on 1st Jan 2026 is 80 million. So this 80 million is the carrying value. Sorry, carrying value 80 million. From this 80 million, we have to reduce the residual value and balance is depreciable amount for depreciable value for balance 25 years. So residual value is 0 here. So depreciation is 85 million, 5 minus 5 million, 80 million. So 80 million is for 25 years. If I divided the 80 million to 25, how much? $3.2 million. 3.2 million is the depreciation for this year. So what is the double entry? Debit depreciation 3.2 million, credit accumulated depreciation 3.2 million. Now pass the double entry here. Depreciation expense. Where are depreciation expense? We close the depreciation expense now. Again take the depreciation to either 3.2 million. Depreciation 2026 depreciation. So close and 31st December charge to the P&L 3.2 million. That's all, right? Now accumulated depreciation take down here, right? take down here. Balance 2026, balance brought forward how much? 5 million. Sorry, this is a first year only took. So accumulated depreciation after 5 years, accumulated depreciation will be, I'll take here, after 5 years accumulated depreciation, balance brought forward will be 5 million, right? So let's charge this year depreciation 3.2 million. Now depreciation, accumulated depreciation balance is 8.2 million. 8.2 million is balance carry forward in 31st December 2026. Let's prepare the balance sheet and P&L. Right? I raise here. We don't need that. We have the data there. Now presentation. Measurement part is finished. Initial recognition done. Initial measurement also done. Then subsequent measurement also done. Final one is presentation. Now take a profit or loss statement of profit or loss for the financial year ended 31st December 2026. This is take the item that is relevant to this question only. Don't take the sales, cost of sale, gross profit. Examiner will not request you. Not only this level, corporate level and strategic level also, examiner will not expect that, right? So here 2026, what are the expenses account? First one is depreciation. So depreciation come under the expense. Open an expense account. Expense. Under the expense, administrative expense. Open administrative. I am giving you tips for the examination also. Administrative expense there, selling and cost there, selling and distribution there, other there, finance there. Then depreciation of the building and building will come under the administrative. So open an administrative. Administrative come under the expense. So open an expense also. Now depreciation of the building. Depreciation of building. How much? This year depreciation is 3.2 million. Right? Depreciation charge. Now open a balance sheet also here. Statement of financial position. Statement of financial position. As at 31st December 2026. Now cost. Accumulated depreciation. Carrying value. Non-current assets. Land. Building. Right? Now cost of the land is, close the accounts now. 75 million. 75 million. Brought forward balance is 75 million. 75 million. Accumulated depreciation how much? Close this now. Right, 8.2 million. Accumulated depreciation is what? Now take a building. Building, close the building. Building is 80 million. Right? Brought forward balance is 80 million. Carry forward balance is 80 million. Brought forward balance also 80 million. 80 million. Okay, building, land done. Once done, put a right. Now depreciation. Take this also. 8.2 million. On 8.2 million gone. 71.8 million is carrying value now. 2026 year. What else there? Now revaluation surplus there. Revaluation surplus we will transfer to OCI. OCI, right? 55 million. This is showing as the increasing the increasing the equity, right? Increase the equity we showing through the profit or loss, but I'll show you 55 million, right? So this 55 million, so debit to land, so asset side increase, so other side is liability side or equity side, we should increase, then only double entry will be telling. Now this expense done, so total expense is 3.2 million, right? Say this profit after deducting this depreciation, profit is say 10 million assumption, right? Profit after tax is 10 million profit came, profit 10 million, say profit 10 million, now tax is 2 million, profit after tax is, profit before tax is 10 million, profit after tax is say 8 million, right? This is showing. After that OCI items will be shown under the profit or loss. They are all the income that is cannot be recognized in the profit or loss will be shown here. All the expenses cannot be recognized in the profit or loss should be shown under the OCI item. Revaluation surplus cannot be shown in here because it's not actually earned income, right? Here revaluation of the building and land, make a pen now 55 million, 3.2 million, right? 3.2 million, 55 million, so is it 55 million? Land 55 million, building 50 million, building 50 million, altogether 105 million. 105 million I am showing here, right? Now total other comprehensive income is 8 million, under 5 million, 123 million. So in this is a balance sheet, right? So let's take a equity side. In equity side, share capital there, return earnings there. In return earnings, right? Return earnings there. After that, revaluation surplus there. In return earnings, say opening return earning is 100 million. Opening return earnings, opening return earning is 100 million. So in this return earning, I will add only this 8 million only. So revaluation surplus, I will add this 105 million. Otherwise, you will think in the return earning we will take 123 million. Again 105 million we will take the revaluation surplus. So 105 million will be duplicated, right? So here return earning will be 108 million. So 100 million assumption, right? Don't try to find in the question, it's an assumption. 105 million is the revaluation surplus. Now equity will be increased. Now equity will be come here. Here revaluation, only one item I am showing. Actually it should not be done this. We have to prepare the changes in equity. Changes in equity, right? In changes in equity, opening balance of each item. First one is say share capital. Second one is return earnings. Third one is revaluation surplus, right? Fourth one is we can take anything, right? We can take all the items which cannot be come under the return earning. Return earning means profit. Actual profit after tax should be saved, accumulated in the return earnings. Others are taking separate column, right? Opening balance we take one by one item we put here. If share issued, share capital will be increased. If revaluation done for land, revaluation surplus will be increased. If profit after tax come here. So after this total only we take here, right? For the easiness, for the to make this simplicity, this calculation I shown here. Actually these calculation, this one transaction, if one transaction occur, you should have the technical knowledge that where that transaction will park, right? This is a great explanation of the revaluation surplus. Let's see what else this question require. After that, now it's require the double entry. We have done that. Now now let's look at the disposal of non-current asset. Good example is there. Nice example. Let's take that. If you write the double entry properly, and if you prepare the financial statement with the double entry system should be passed to the T accounts, general ledger. Once you prepare the general ledger, close the general ledger and prepare the trial balance. After preparing the trial balance, you have to find out each item are related to which financial statement element. Based on that, you have to decide whether it's debit or credit, right? Financial accounting subject is very interesting subject, because there is no it's not like a biological subject. It's clearly we can see where these transactions came, how we have to park this transaction. Always think, if any transaction happen, finally where this transaction going to park, right? Finally all the cost for the asset, right? All the capital expenditure, all the revenue expenditure will be parked in return earning. Even though you spend for the capital expenditure, each year gradually we will charge as the depreciation to the profit or loss. The profit or loss means profit or loss will be reduced. Profit will be reduced by the depreciation. So automatically return earning will be reduced by the depreciation. Finally, that's why business intention is making a profit, right? Let's take a question in page number 28. Right? Business purchased a non-current asset on 1st January 2021 for rupees 25 million. Right? Purchase cost of the building. First Jan 2021, 25 million. It had an estimated life of 6 years. Lifetime 6 years. Estimated residual value 7 million. Residual value 7 million. Now you should have a mind calculation. Depreciable amount is 18 million, right? So 18 million divided by 6 is 1 year depreciation is 3 million. That should be come in your mind. Then only you will be a financial accounting student. මේමනේ බබා වෙන්න එපා. හරිද? මේක ඔයා හිතන එක හරි. What you are thinking is correct. Think like that. Don't think chartered is very difficult subject. Someone needs to guide you. No, dear friends. What is you are thinking is correct. Way you thinking, right? Reflecting in the answer paper. Therefore, don't believe anyone. Believe yourself and find a solution for the answer yourself. Right. Then, what is next? Asset was eventually sold after 3 years. After 3 years. After 3 years sold. After 3 years mean date is when? 31st December 2021 is 1 year. 31st December 2022 is 2 years. 31st December 2023. 31st December 2023. Right? 3 years. No need the max calculation. Don't add the 3 years and see. Just calculate with a finger. That's enough. Right? Don't be a systematic approach for everything. Right? Systematic approach for that prepare in the double entry and prepare in the GLM, prepare in the trial balance and financial statement is okay. Calculation of the number of years, don't follow the systematic, follow the just manual calculation, manual method, by mind or by finger or by writing in a paper, right? Now on Jan 2024, right, only one day later, let's make nothing different, that is 17.5 million. Let's look at after 3 years what is the carrying value, then what is the profit. What was the profit or loss on disposal, assuming that the business uses the straight line method for depreciation? Why, I don't know why Chartered Institute giving this type of very easiest question. In your exam also you will be getting this type of easiest question. So disposal of income, on the disposal date, right, we will prepare a GL and do the financial statement, then you will understand, right? So 3 years depreciation, so purchase cost, now I am doing the calculations, not a systematic method. Purchase cost is 25 million, residual value is 7 million, depreciable value is 18 million, right? 3 years depreciation, 18 million divided by 6 years into 3, 9, right, 9 million. So cost is 25 million. After 3 years, 16 million is carrying value. Selling price is 17.5 million. Profit is 1.5 million. Is it difficult? Straightforward, you can do, right? 1.5 million is profit. It's very easy. How we have to pass the double entry on the date of disposal? Let's look at that. That is difficult. Now 3 years depreciation. After 3 years depreciation, right, what will be the what they purchased? They purchased a non-current asset. They mention only non-current asset. I also take as a non-current asset. So when purchase the non-current asset, so on this point, debit non-current asset 25 million, credit cash 25 million, right? So 1st Jan 2021, non-current asset account, 1st Jan 2021, cash 25 million, right? Now first year we passing the first year depreciation is 3 million. Now open a depreciation account. Now this is our practical example. This is depreciation of non-current asset. If this is a building, I will say depreciation of building, non-current asset. So first year depreciation is, say, 31st December 2021, accumulated depreciation of non-current asset is 3 million, right? Now open an accumulated depreciation account also. Accumulated depreciation of non-current asset account, 31st December 2021, depreciation of non-current asset 3 million. Now 1 year closed. Now we close the accounts. Now 1 year closed. No, close the account. Accumulated depreciation I close. So 31st December 21, balance carry forward is 3 million. This is I am closing 3 million, transfer to P&L 3 million. So it not be brought forward. Now I will close this also. 25 million, 31st December 2021, balance carry forward 25 million. 1st January 2022, balance brought forward 25 million. It's a first year transaction. It's a first double entry pass. Second double entry, when depreciation pass, debit depreciation, credit accumulated depreciation. That's all. Now after 3 years we have to charge like this, right? 3 years we have to charge like this. Continue as same accounting procedure, right? Here also brought forward balance come, again depreciation charge. After 3 years this balance will be 9 million, my dear friends, right? Balance brought forward will be 9 million here. Here no balance will come, right? Here after 3 years balance will be, say after 3 years I taken balance brought forward is 25 million. Now on this day we disposing. When you disposing, cost should be taken out. Now cumulative expenditure also should be taken out. Cumulative income also should be taken out, but here no revaluation surplus. Revaluation surplus is the cumulative income. Now on first day, this is the first Jan 2024, we are removing the asset, right? Yeah. Now we'll transfer this everything to one account and calculate the profit. We have to open a disposal of non-current asset. Disposal of non-current asset account. If it is a building, I will open a disposal of building account. Now change this, debit disposal account 25, credit non-current asset, always put a data, very important, date is very important. 20. Now it will become a 0, right? It will become a 0. First day it is 0, right? No balance brought forward. Now we will take that also. First double entry for disposing the item is here. First double entry is debit here. Debit disposal account 25 million. Credit non-current asset account 25 million. That is fee passed. Always double entry. I am used to use boxes. If you want, you also use the box. It's differently highlighted, right? Once done, put a tick. Second double entry is taking the accumulated depreciation, right? Second double entry is debit accumulated depreciated 9 million, credit disposal account 9 million. Disposal account 9 million. Here accumulated depreciation 9 million. Now we sell for, now it will become a 0, right? Accumulated depreciation become a 0. We will sell for 17.5 million. When sale occurs, debit cash 17.5 million, credit disposal account. We have taken all the things to disposal account 17.5 million. So credit cash 17.5 million. Total is 26.5 million. 26.5 million. So profit on disposal. If other side come loss, profit on disposal is 1.5 million. It will be taken to profit or loss. Now all account closed and came here. So debit disposal account, credit P&L is the final double entry. Yeah, this double entry passed, right? Now final double entry is debit disposal 1.5 million. That is we have to find. We have to find through this calculation. Credit P&L 1.5 million. Now there is no balance sheet amount. everything come to the P&L. After P&L, calculating the profit or loss, that is also charged in showing under the retained earnings. So see, non-current asset, accumulated depreciation, disposal, depreciation, all are come to the P&L, finally shown under reflecting in retained earnings. That's I am telling. All the expense, all the liability, all the income, all the assets, everything will be parked in retained earning. That's why retained earning should be appreciated. Businessmen are like to increase the retained earning. Retained earning is the profit accumulation. Accumulating the profit in retained earning. Once retained earning higher, they can take a money out, drawings, through the dividend or drawings, right? Now, how many double entries there? 1, 2, 3, 4. 4 double entries we have to pass in this. If revaluation, there are 5 double entry. Revaluation also transfer to the profit or loss. Or revaluation can be transferred to disposal account and taken to the profit or loss. 2 ways are okay, right? Now I believe we completed the non-current asset. So this is the maximum application of the LK16, my dear students.
Thank you for watching the video. Stay tuned with castudies.lk for more lectures online.